Hello, everybody. So I wanted to cover a few stocks for the channel. These are stocks that I've covered before, except for Unity. I have not covered this stock before, but it's a stock that I've been following on and off, and that is very popular on YouTube, and that I kind of like. I think it has a lot of good things going for it. And so the goal of this video is to, of course, show you my usual valuation of my usual spreadsheet. So enterprise value over gross profit over revenue growth, which answer the questions: how much am I paying for each percentage point of future growth? And so, of course, the lower the cost, the most undervalued the stock is. This is my spin on the PEG ratio, my modification of the PEG ratio. By the way, none of these are expensive. If you look at my average when I do my very large spreadsheet on Fridays with more than 30 stocks, none of these are expensive, because the average that you get on EV over gross profit over revenue growth is usually a 0.6, a 0.6. So Unity, for example, would be half as cheap as the typical stock that I cover on the channel. So it's not expensive growth. It is cheap growth. And why do I like Unity, or like why am I changing my mind about Unity? Well, if you follow Unity, you know that the CEO has been the problem with Unity for a long time. Very, very rent-seeking, nickel and diming, merger inducing, and they did a merger that I did not like, and that I think a lot of people didn't like. Acquisitions type of CEO, very old school, very much about rent-seeking, profits before all. And of course, he went too far in the profits making, and you may have remember this trending on Twitter over quite a while, and it was backlash from their game developers. So Unity, if you don't know anything about Unity, what Unity does is it's a game engine mostly for mobile platform, and so their main competitor is actually owned by Tencent and is Unreal Engine, but their main competitor is more for the desktop and professional type of games, and more for pro gamers, and Unity provides games that are more for casual gamers, or at least that is my understanding. But there's more and more of a blurred line between the quality of the games. But anyways, they have, I don't really like moats on this channel, but they have clearly a moat. They are a duopoly in the platforms for making games, along with Unreal Engine. And of course, if you believe in the digital world that we are living in, and that the fact that most people today spend most of their waking hours on an electronic device, and if you think this is only going to increase, then we realize that, of course, entertainment is going to move away from sports and is going to move into digital sports or esports or simply video games. And I think that's the future where we're headed. This is also a company that could greatly benefit from the advent of virtual reality, from the advent of Apple Vision and Apple Vision Pro, these goggles that Apple is releasing. This is a company which, over the long run, over the next 10 to 15 years, I would be very bullish about this positioning. But again, they had a CEO whose main purpose was to kill that company, and because it was a rent-seeker CEO who just wanted to make profits now and entirely forget about the future. Well, guess what? What's the great news? The great news is that the CEO has been ousted, because it literally turned the entire customer base against him, because it wanted to start nickel and diming them and paying them for back fees and back profits, etc. And the CEO is gone now. And of course, this is I'm making this reference because I'm talking about video games, but this is where I think we may live in a parallel universe. Like, the fact that the CEO is gone is the best thing that could happen to this stock. It's the best thing. A stock like this that's future-oriented, you can't have a rent-seeking type of CEO in a future-oriented stock. Like, that's not how it works, right? That's not how you gain market share. That's not how you gain new game developers, new customers, new people to use your game. You can't do that if you're just trying to make money now, right? A stock is the present value of all future cash flows. Well, if you make all of the money now, there's going to be no future cash flows left, right? Stocks are looking forward. So anyways, the market hates it. The market hates that the CEO is gone. The stock is actually slightly down, went up like slightly on the announcement, but barely while this is a news that should allow this stock to regain everything it has lost ever since the backlash that happened about their game change. So I've never covered the stock fully on the channel, and I don't own the stock. Let me know in the comment section what you think about Unity and if you think this is a stock that I should look into a little more, but I like the positioning of this company. Let me move on to C Limited. So C Limited, my question is growth coming back? And you may remember that one of the main reasons why C Limited is showing up as expensive in my spreadsheet is because analysts, and I'm in alignment with them, are only giving them 8% revenue growth. Why is the revenue growth so slow? Because they have a rapidly declining gaming division, because their gaming division saw the ban of their most popular game, which was called Free Fire, and it was a game that was mostly played in India, and India banned it. And as a result of that, that gaming division has been eating all of the revenue growth away, like the revenue growth that they have in C-Money, their fintech, revenue growth that they have in their e-commerce division. That revenue growth has been eaten away by the decline in the gaming division. And we had amazing news, right? A month and a half back, where India allowed again the game. They allowed again the game. Now, I should note, the game should have been launched in September, and it has not been launched yet. And my guess is that this has to do with the servers, because the servers have to be located in India, and there has to be some compliance, some red tape. So I think this has to do with the servers, although we haven't received an announcement as to when that game is actually coming back. But the game is coming back to India. And if you look at that in YouTube, and you just have Free Fire India in YouTube, you can see, I mean, these videos have tens of millions of views. And the video that announced the game again, I think, has nearly 10 million views. So this is a very popular game. If it comes back, that means we're halting the bleeding in revenue. That means we may hope to have a flat gaming division, in which case then the growth from the e-commerce section of C Limited would really start to show on the top line of the income statement, which is amazing. And we've had another amazing news, right? A few days ago, we've had another amazing news, which is this. The news is that TikTok is getting banned in Indonesia, and there may be other countries that ban TikTok, and that could greatly benefit a business like of course Shopee, which is the e-commerce division of C Limited. That could greatly benefit if you've been following TikTok and TikTok's e-commerce push, e-commerce shopping division. It's been making the headlines. It's been doing a really bad narrative. Now the whole idea is TikTok Shop. Is TikTok Shop going to end up like Wish.com? You may remember Wish.com a few years back. I don't know what the long-term durability of this business is, but anyways, it was banned in Indonesia, the biggest market of C Limited, which means that one of their bigger threats in e-commerce is now going away. So this is a stock whose growth could resume. I have covered the stock multiple times on the channel, and I think this company is looking more interesting with its two pieces of news, meaningful news right now. Let me move on to LifeMD. So LifeMD, unfortunately, is cheap still, but it's not nearly as cheap as my last video. I covered LifeMD. I covered them a little more than 6 months ago on March 30th, and it's a 3.5x since my last video. So that's great, but since the stock went up so much, first of all, it may take a breather. That's typically what happens when stocks run so much so fast, right? 3.5x in 6 months is quite a bit. But also, very interestingly, in the meantime, HIMS, when I made this video on LifeMD, HIMS was trading in the $10 to $11 range. Now HIMS is trading at $6 range. So if you look at my enterprise value over gross profit over revenue growth ratio, the ratio for HIMS is actually a 0.03. So in the way I value stocks, HIMS is now 3 times cheaper than LifeMD. And when I covered LifeMD was actually cheaper than HIMS. So this is where, trading in pairs kind of works, and, maybe swapping from one stock to another may be a good idea, depending on the tax situation that one is in. That may be a good idea. Now, the problem is that, of course, LifeMD ran too fast, and so you would have a 6 months capital gains, which means that you would be paying short-term capital gains, which is never ideal. What am I doing with my LifeMD position? I am holding on to it and not doing anything with it, but I am adding to HIMS and not LifeMD right now because it has run up so much. Good for them. It was clearly a mispricing of this stock, and you may want to look back to the video that I made about LifeMD back 6 months ago. And lastly, we have TYGO. So you win some, right? With LifeMD, you win some and then you lose some. That's the problem with investing in small cap. And I have a very, very small entry position in small cap. That's why I really don't care about how much it dropped. The only thing I care about is that should I keep adding or not, because my position is so tiny. It's almost like having no position. It's meaningless at this point. The only thing that I'm wondering is what should I do? Should I add or not? And no, I will not add to TYGO. I will keep it, but I will not add to TYGO because it's true that the change in the guidance that they've issued for us is really, really stunning. I mean, I don't understand this change in the guidance in just a matter of 2 months, because if you look on August 22, if you go on their website, you can see the press release on their website. CEO talking about how they're going to be a multi-billion-dollar company, everything's great, everything's doing amazing, saying, oh, we're growing at a fast pace, expected to sell over $200 million this year. And then we get an announcement 2 days ago saying that the growth that they were expecting is moving from $41 million to $17 million. So it's almost divided by 3. Like, I cannot understand this. How can how apparently they've had order cancellations and they've had other things. But if you read this article, they tell you that everything's going well and that orders are picking up. So, I don't understand. Either things changed very, very, very quickly in a matter of 2 months, not even 2 months, in a matter of 2 months, not even 2 months. Like, they may have changed very, very quickly. Or this might have been unwarranted optimism, and this might have not been exactly what's going on at TYGO. This article, I don't understand how you could have a bullish article a month and a half before you have such a negative news. I don't get it, and that's why I think it's important. These new issues, these new stock, you gotta trust the CEO and keep following the CEO. And if I compare this to Enphase and Badri, Badri can be trusted in my view. Like I trust Badri. He's been a very honest CEO. He's always been saying it like it is. There's no fluff on the conference call. And by the way, we know right now there's inventory issues with Enphase. But if you look at the inventory issues of Enphase, just like TYGO, right? They're going through a similar section. Enphase, the drop in inventory compared from Q2 to Q3, so they're expecting their guided decline is only a minus 10% at worst. Like this is a minus 70%. This is not minus 10%. I do not know what to say, but this seems like there has been some over optimism going on. Like I have a hard time believing in that in a month and a half business changes like that. And that's why I think it takes a lot of time for a business like TYGO to prove itself and for them to get into the correct way to communicate with their shareholders, right? We know, like some CEOs, we know how they communicate. For example, Elon Musk. We know that whenever Elon Musk says something, you gotta have 12 to 18 months before it happens, right? The market knows that. The market has recorded that, and so we know what to expect from that CEO. Now I don't know what to expect from that CEO, but when I see crazy positive language from that CEO, and then when I see this change, I don't place a lot of trust on what it said and on what he says, and that's a big problem in investing. How could you have such a stark turnaround. If I had a big position, I would be, I would be upset. And that's why I'm starting only with very small position all the time, very small position. Start with a small position. And maybe this is just a very volatile business, and maybe in Q4 they do 65 million, and if they do 65 million in Q4, then it will exceed 200 million, and then that will not look like it was overly optimistic. It will look true what is said here. But are they going to do 65 million? I mean, is this a company that's going to be so unpredictable that, revenue can be, divided by more than 3 and then multiply by 3 again? Is that possible? I don't know. We don't have enough of a look back on this company. We don't have enough history with this company. So anyways, I'm keeping my share. It seems to me like a lot of the volatility is overreacting. There's a little bit of an overreaction because this is a company that's nearing trading at one-time sales. Let's be honest, But nonetheless, I'm not adding either at this point. So this is it for this video. This is not investment advice. As always, stocks are very risky and volatile, as you can see. This is just entertainment. Appreciate your likes, appreciate your subscribes, appreciate if you follow me on X. Thank you so much for watching.